Have you maximised your tax allowance this year? Reports from the Institute of Fiscal Studies suggest that a significant portion of the population are not maximising their tax allowances, and that's leaving hundreds and even thousands of pounds on the table every single year by not taking action before the 5th of April deadline. And even if you think you do, changes to fiscal policies might have changed your situation without you knowing it. Now, my team and I have spent years maximising our clients' allowances, helping them become better off. So here are our top 7 simple and effective ways to ensure that you keep more of your money away from HMRC. First off, let's talk about ISAs. They're easily the most important thing you could be doing before the 2025 tax year ends. Individual savings accounts, ISA, a really tax efficient way to save and invest your money. Now, the reason for this is because ISAs are tax free, meaning any interest you earn isn't subject to that pesky income tax. Now, that's not like a normal savings account where you've only got £1,000 allowance as a basic rate taxpayer on interest earned. It's even lower if you're a higher rate taxpayer, as you only get a £500 allowance before you're expected to start paying tax on it. With ISAs, you've got an allowance that resets every tax year, and if you don't use it, you lose it. For the 2024-25 tax year, you can save up to £20,000 in an ISA, shielding your savings or investments from tax. Stocks and shares ISAs are great for long-term investments, while cash ISAs work well for emergency funds. Now, let's say you invest the full £20,000 for the year. Your investment then grows by 10%. That means your portfolio is now worth £22,000. That's a 5-star 2-week trip to the Maldives. Or if you're feeling super hungry, 4,400 Domino's pizzas. Not sponsored. If you haven't used yours yet, consider moving money before the deadline. Your future self will thank you. Next, at number 2 is one of the most underused tax saving strategies by UK taxpayers, salary sacrifice. Now, this is where you agree to exchange part of your salary for non-cash benefits, such as workplace pension contributions, cycle to work schemes, or even childcare vouchers. And the benefit? You lower your taxable income, which in turn means you pay less national insurance and income tax. Think of it like this. Imagine you're at an all-you-can-eat buffet and you're being charged based on the weight of your plate and not the amount of food on it. Salary sacrifice is like strategically swapping that heavy mountain of mashed potatoes for a lightweight but valuable portion of premium sushi. You're still getting something of great value, but HMRC isn't loading up your plate with tax charges. If you're a higher rate taxpayer, this is an easy way to boost your pension while paying less tax. Speak to your HR department or payroll department to see what salary sacrifice schemes they can offer. Moving on, at number 3, every individual, yes, even you, has a capital gains tax allowance, CGT for short. For the uninitiated, capital gains refers to the profit you make when you sell an asset like stocks or property or other investments. To explain further, it's when you've sold it for more than you originally paid, taking into account any relevant costs. For the 24-25 tax year, the CGT allowance is a paltry £3,000. Yes, £3,000, ridiculous. If you have investments, properties or assets that have gained value, you can sell strategically to avoid paying tax. Let's say you purchased shares in Apple a few years ago. Since you made the purchase, the stock value has increased significantly and you decide you want to benefit from your very wise investment. So what you can do is strategically sell them so it fits within your allowance of £3,000. That means splitting the sale across multiple years to maximise your overall tax efficiency. A little bit of thought put into it. Better yet, if you're a basic rate taxpayer, so you earn under £50,000, you only pay 10% on any income that falls outside of that £3,000. So if you make a £10,000 gain, only £7,000 of that is taxable, and it's £700 at the basic rate, leaving the rest in your pocket. And by the way, it's different for a business. These have capital allowances, where you claim an amount for the fair use of an item over the number of years you expect to use it, plus something called an annual investment allowance, AIA for short, and that allows you to offset the total purchase cost of any qualifying items against tax in the year you buy it. So if you are planning any purchases purchases of equipment or machinery in the next few months, why not bring it forward and buy before the 5th of April to claim the tax deduction? You can claim it now through your annual investment allowance. Just make sure the purchase or the contract is done before your year end, and the full cost can then be claimed against your tax. And by the way, if you're finding these tips helpful, please don't forget to click subscribe below, because we're a small channel hoping to help you save big in taxes. If you get to the end and change your mind, no probs, just unsubscribe. Dead easy. Now, digging deeper in pension contributions. This is actually one of the most tax efficient ways to save. But you might be wondering, well, how do I contribute? If you're currently employed, your employer will probably already have you enrolled in a workplace pension scheme. Contributions then are taken directly from your salary before tax, taking all of the legwork out of contributing. However, it's likely the contributions being made are the bare minimum, and we'll talk about how to optimize the amount in a sec. You need to be eligible as well to even be enrolled in the first place. How stupid is that? The current eligibility requirements for pensions are as follows. So firstly, by age, employees must be aged 22 or over and under the state pension age. Then by earnings, employees must earn more than 10,000 a year or the equivalent on a weekly or monthly basis. And then it's location. Employees must ordinarily work in the UK. If you really want to take matters into your own hands, this is where you can set up a SIPP, SIPP, a self-invested personal pension. Now this bad boy is for all of you self-employed workers, freelancers or employees who are fed up with their employers contributing the bare minimum. You will have to put in some work to get this set up, but I promise it will benefit you in the long run, so don't be lazy. First, you need to set up an account with a pension provider, and I'll give you some recommendations for those in a moment. But once that's done, you can contribute up to 60,000 per year or up to your earnings if they're lower than 60,000 and receive tax relief. And the best part is the government contributes 25% of what you pay as well. So for example, every £80 you contribute, the government tops it up to £100. It's free money towards your future. You have a few options when choosing a private pension provider, but some of the popular ones are Pension B, Hargreaves Lansdown, AJ Bell, and Aviva. And I'd recommend just having a chat with a business representative from each of those to scope out, whether it suits your needs before you fully commit. Talk to a few of them, get a good feel for it. If you're close to retirement, you might even be able to carry forward unused allowances from the past 3 years. That's right, even if you've been slacking on contributions, you can still play catch up. To be able to do it, you'll need to first of all check your eligibility. So that means making sure you have earnings at least equal to the contributions you're looking to make. Also that you were registered as a member of a UK registered pension scheme for the years that you want to carry forward. So if you were only registered as of the 22-23 tax year, you could only carry forward your unused allowance for that year. Once you've assessed the amount you can carry forward, you'll need to declare the additional contributions on your self-assessment tax return. If you're unsure how to do this, feel free to book in a discovery call through the link in the description for some more bespoke advice and guidance. This next one is for all my homebodies who lounge around in their slippers and jogging bottoms whilst answering emails. Why not? Corporate on top, comfy on the bottom. If you work from home, you can claim back some of the costs associated with your heating, your electricity and your broadband. HMRC allows you to claim £6 per week tax-free without needing receipts, which is up to £312 per year. So that's known as the benchmark rate, and pretty much everyone and their nan can claim tax relief for this. If you're an employee, it's as straightforward as going to HMRC's website, finding the HMRC's Working From Home Tax Relief page, and from here it's just a matter of logging into your government gateway or setting up an account if you haven't got one already, and then enter in the £6 a week benchmark rate. Now from here, HMRC will adjust your tax code and relief will automatically be applied to your salary. If you're self-employed, you can go even further. You can claim a portion of your actual expenses, including rent and council tax, through simplified expenses. It's a little like giving your tax bill a bit of a haircut, and who doesn't love a fresh trim? You'll need to add this to your self-assessment tax return under the section for business expenses. When it comes to claiming bespoke figures, you'll need to base this on the following formula: total home costs times total house area divided by business area times total hours divided by business hours. Now, are you feeling generous? At number 6, use your annual gift allowance. You can give up to $3,000 per year to family members without it affecting inheritance tax. Plus, small gifts of $250 per person are also tax-free, and there's no age limit to this, so you can start planning as early as you'd like. If you haven't started handing out cheques just yet, you'll be pleased to know that you can also carry forward your last year's allowance as well, increasing your allowance to £6,000. Now this way, you start distributing your money before HMRC can come along and demand their share of it. And the sooner you start, the more of your money stays in your family's hands instead of the taxman's. Another trick is if you've had a wedding in your family recently, if your child's tied the knot, you can gift them an additional $5,000 tax-free as well. And even better, you can combine this with your annual gift allowance as well. That's up to £8,000 in most cases. And the great thing about giving gifts, other than the joy of simply giving of course, is that you don't need to submit a form to HMRC to declare it. The only thing you need to do is gift the amount you'd like. We would recommend keeping a record of any gifts, however, as HMRC can still ask to see your records. And also remember, there is a 7-year rule in place, so don't die within 7 years of making the gift, or there may be some tax due. Rest in peace is not a phrase HMRC know. You receive what's called taper relief on the tax. So for example, if you die within 0 to 3 years of gifting, you face the full 40%. However, if you die within 6 years, it's only 8%. Definitely not as scary as 40%, but wouldn't you rather not pay any tax at all? Legally, of course. Speaking of weddings, super expensive, right? Why not get a little cash back from HMRC? If you or your spouse earns less than $12,570 per year, you may qualify for the marriage allowance, allowing the lower earner to transfer $1,260 of their personal allowance to the higher earner. There's a hitch though, pun intended. The other partner must be a basic rate taxpayer still, so they can't earn above $50,000. To give you an idea of how this works, let's say you earn $30,000 at the moment and your partner earns $10,000. Now your partner can transfer $1,260 of their tax-free allowance to you, saving you a sweet £252. Now this is because before them transferring their personal allowance, you would have been paying 20% on $1,260 of your income, which is $252. And since this amount is now tax-free, you're saving that. Oh, and before I forget, if you haven't claimed it previously, you can backdate it up to 4 years and receive a lump sum refund. Double sweet. And no, you can't claim it for your on and off relationship that you've had with that person on Tinder for 7 years. Don't think HMRC accept complicated as a relationship status. With the 5th of April deadline fast approaching, now is the time to take action. Catch you next time.